Welcome to Subramani. I'm going to talk about a concept called mean reversion. It's not that I have not done it in the past, but I'm just trying to redo a session just on mean reversion. What is mean reversion? Mean reversion says that if the performance of a fund has been very good for a long time or for some time, then the performance is likely to come down, and a fund whose performance has not been good for a long time, the performance is likely to come up. So some reversion to the mean, coming back to the average, is going to happen, whether it is funds or whether it is equity markets. This is one concept. The second concept that you have to understand that returns can be upfronted or back-ended, okay, upfront or back-ended. So what am I trying to say? Let us say we are expecting 12% returns. So 12% returns means in 6 years your money should double. That should be your expectation, that in 6 years your money should double. That is your 12% return. So if the returns are 12%, so 72 divided by 12 is 6. That is called the rule of 72. So it's important for you to know these concepts. Now, you have put 10 lakhs of rupees on maybe in 2018. So by 2024 it should have doubled. But what could happen is it could double in 1 year. Right, so you put your money and you put your 10 lakhs, you know it's going to become 20 lakhs in 6 years time, or that's what you're hoping. But it could happen that it gets doubled in 2 years time. So in 2018 you put, and by 2020 it was already double. Now to expect that it will double again and again, so which means 10 lakhs became 20, 20 will become 40, 40 will become 80, would be completely wrong expectation. What has happened is your return between 2018 to 2024 has been completely upfronted and given to you in the first 2 years. So next 4 years could be zero, or next year could again be some humongous figure of 20% or 25% after your money has doubled, and the year after that you could get a minus 10% kind of a return, compensating for this which had already happened. To think that I've got good returns, I will continue to get that, is wrong. This is very important for people whose expectations from the market are 25%, 26%. What is the use in investing in large cap when I know that small cap will give me 40% return, 30% return? This is not going to happen. So you have to understand both these concepts of mean reversion and interest being or the gains being upfronted. It will not, you will never get 12% return in equity as 12. That will never happen, never ever happen in equity. But what is likely to happen is 1 year you get 24%, year after that you get another 24%. So you start thinking, Supra is very scary, he says you get only 12. Actually, I have found that in the market in the last 2 years, 3 years, 4 years, whatever, I have got better returns. I've got much better returns than what Supra promises on this channel. Look, first of all, it's not a promise. Second, you have to understand that if you are in the market for 50 years or 40 years, you will get average returns. Nothing wrong with that. The average returns from equity market are better than the average returns that you would have got in gold or real estate or bank fixed deposits, and some of them are very tax inefficient also. So having said all this, it's important for you to understand that the returns have been upfronted, so you will get less returns at the end, or the cycle could be 4 years. And after 4 years again for second cycle. You don't, when I said 6% and when I said 12% and 6 years, it's just a guess. I mean 2018 to 2024 what should have happened, it's easier to guess, but we are in 2025, and in 2025 what is going to happen is what we have to look at. So if you have got a lot of good returns in equity over the last few years and it has gone way beyond what you thought you will get, maybe it is time for some rebalancing and putting some money in debt, maybe gilt, so that some part of the equity profits you have taken off the table. The other way to look at it is to say, oh, market has already corrected by 15% or 18% or 20%, whatever it is, I have no clue, from the time that you last withdrew. Maybe it is time to stop the withdrawals from equity and start withdrawing from debt. All these possibilities are there. So to remember that a 12% return actually means 24% return followed by 0, and you are still comfortable because your money has already doubled in 2 years and you thought it will double in 6 years. So if sometimes suddenly you find that you've got 89% return in equity, which happens sometimes, is you have to be ready, bracing yourself for the fall which is going to happen next year. So this is a fantastic time for you to take some money out and indulge yourself, because you know this kind of returns is not going to happen and your debt bucket is already full, so you don't need more debt. So this is a time to take some money off the table from equity markets and go and have fun. Whatever, I mean, you shouldn't remove more than 2-3% of the portfolio, because after that if the market falls, and then for it to come back takes more time. So if you do some, so let me just tell you what Jason Zweig, who's the only article I read in Washington Post, says. He says, from financial history and from my own experience, I long ago concluded that regression to the mean is the most powerful law in financial physics. He calls it physics, right? Just like gravity, because once the market goes up too much, you think it won't come down, gravity pulls it down. So gravity is applicable to portfolios too, right? And you know how difficult it is to get it up. You need a jet engine and jet fuel to be able to take it up, but bringing it down is much easier. So periods of above average performance are inevitably followed by below average returns. Now please remember also, it is possible that for 10 years you get 14-15% kind of return, and then people come and start telling you that the market is going to sustain, higher growth is going to happen, now is the new normal. So you thought 12% was right, but actually I think a new normal is being set and you will start getting 14% return. You will hear all this. I mean, and it may sometimes be right, so partially right and partially wrong. So you have to be careful about that. So what he says is mean reversion is the pull towards historical averages. So it's gravity and pulling power both working in tandem, just to keep you in place sometimes, and sometimes to tell you, look, all the returns have been upfronted, so you can't get anything more. And when you talk of valuations, you have to be worried about if you bought stocks maybe when the index was lower and now the market is higher and you are not very comfortable holding that stock. That's a fantastic reason to sell, not because of anything else, not because of your asset allocation or anything, but you say that's enough. I don't think I can take, I don't have stomach to take a greater return with a greater risk at this age. So when you invest, when the say interest rates are low or valuations are low, you're making yourself extremely eligible for the future profits. But when you are investing during a bull market, when everything looks overpriced and you what you actually need to do is sit on cash for long periods of time, you find that it is going to be very difficult. So but that is what you have to do to understand mean reversion, and to understand the fact that some of the returns may have been upfronted already for your mother. So whether we will repeat, something like this,